So as we have people stream into the room, both here in person in Austin and on the app right now virtually, I want to take a little bit of time before we start our official event for this evening, which is the Galbraith lecture, to give some results from last night. I think for those of you who are here for the awards ceremony, we had our long-standing tradition of the finals round of the Academic Bowl, but for the first year, we challenged people both at home and here in Austin in the audience to try to play along with the students. And so I ran that, but it went so fast I wasn't able to score, but I have some results to give. And for those participating online, our first place, and you might just get bragging rights, but there's a chance you might have a gift show up in your mail. For online, Stephen Morgan from the Economic Research Service was our winner, and tied in second was Melissa McKendry from Michigan State University and John Lay from the University of Florida. Congratulations. They are past actual Academic Bowl winners from a while ago when they were undergrads, so it's kind of cool. And then in person, our first place was Gracie Heron from, I believe, Clemson University. David Hagan and was second place, and Samuel Dahman from South Dakota State University was third place. So thanks for playing along. And again, at bare minimum, you have bragging rights. So with that, let me turn to this night's festivities, which is the Galbraith Lecture. For those of you unaware, we, throughout our history in the AEA, have had generous donors want to support our programs. And I'd say, I think it was about a decade or a decade and a half ago, we had a set of our donors come up and say they really wanted to honor the memory of Dr. Galbraith and the work he did, and use it as a way to bring high-profile speakers to our programs to make our annual meetings even more impactful. So each year, our president, this year that was me, charges a committee to choose such a high-profile speaker. And this year, we are honored to welcome Dr. Gita Gopinath to be this year's Galbraith Forum speaker. Gita is the economic counselor and director of the research department at the International Monetary Fund. She is on leave of public service from Harvard University's economics department, where she is the John Zonstra Professor of International Studies and Economics. Ms. Gopinath's research, which focuses on international finance and macroeconomics, has been published in many top economics journals. She has authored numerous research articles on exchange rates, trade and investment, international financial crises, monetary policy, debt, and emerging market crises. We, of course, would love to have her here with us in person tonight, but we're excited to have her virtually join us in our live stream. Thank you and welcome to Gita.
Hello, and thank you so much. I can't really see people over there, but thank you so much for the kind introduction. And I assume you can hear me and you can see my screen, which I'm going to put in full screen mode right now. So can you tell me if you can see me? Somebody can just say something. Can you see this?
We see you.
Okay, great. Thank you. And it's a real honor to give the Galbraith lecture. I was a student back in India when I was doing my bachelor's from Delhi University, and I think one of the first lectures I actually went to attend, kind of a public lecture that I went to attend was when John Kenneth Galbraith came to India.
Recording in progress.
To give a talk, and he was this towering figure in literally speaking too. So it was quite an impression, and so it's truly an honor to give this lecture. So I just looked at all the lectures that were given in the past, and it seems like what would be useful is for me to talk about a body of work that I have spent I would say about a decade now working on, and recently I just I'm working on a handbook chapter on this particular area of work, and so I had the opportunity to kind of bring together all the different ideas around this in this area, and I thought I would share this with you. I mean, I have given talks on this particular topic, but I feel like I'm able to bring together the different contributions over the last decade, not just from me, but from many others. And I wanted to share these with you. So, looking forward to your questions and comments. Let me just jump in. So the title of the lecture is The Dominant Currency Paradigm, and with reference to international economics and international price setting, basically in trade, in global trade. And I've highlighted the DCP for a reason, because you'll see that there has been a literature that has have other kinds of pricing paradigms, which I'm going to get into. Okay, so to jump in directly, there are about 180 currencies in the world, but only very, very few get used in international trade, in international finance, or when countries are accumulating foreign exchange reserves. So the picture you see here shows you the share of different currencies in, so the leftmost bars are for foreign exchange reserves, and then you have in foreign currencies used in international debt, currencies used in international loans and deposits, and foreign exchange turnover, export invoicing currency, global payment currency. And what you see is that, first of all, there are just very few currencies that add up to 100% in terms of shares. And secondly, the US dollar dominates in pretty much all of these dimensions, right? And so you do have a role for the euro, which comes in second, and then you have the yen, which comes in third. But basically, once you've covered dollar, you've gotten to over 60%, in cases 70%, and then you get the other currencies, some other currencies playing a role. So that's what the world landscape looks like, which is one where there are very few currencies that have a central role in trade finance and in international reserves, and the US dollar has a dominant role. Now, this is not news. It's obviously been known for a very long time. We have better data, so we can see some of these statistics now. But when you look at the history of this, you had a time pre-World War I when it was the British pound that was the dominant currency of the world. And if you had the same picture for that time, it would look with the British UK bars being the biggest. And right now, it's non-existent. The British pound doesn't exist as a major currency in the international arena. So this has always been the case. However, if you look at the international macroeconomics literature, Keynesian macroeconomics in the international domain, if you look at that whole literature, it treated this feature of dominant currencies as more the exception than the rule. The focus was very much in terms of understanding international trade between countries, where the countries were symmetric in the sense that every country either exported their goods in their own currency, this is the most famous one, the one that also drives a lot of policy decision making. It's the classically known as the Mundell-Fleming paradigm, where every country sells to the world and the prices at which they sell to the world is in their own currency. And why does that have any meaning at all, what currency it is? It has meaning because these prices are sticky in the currency at which they sell to the world. Right, so that was the standard assumption in all the kind of analysis that's been done, is to assume symmetric frameworks. It's also the reason behind Friedman's argument in favor of flexible exchange rates, which is the fact that the assumption underlying that is that every country sells to the world in their own currency, and prices are sticky in that currency, in their own currency, and therefore exchange rate movements give you beneficial adjustments, which make flexible exchange rates very valuable. So what has changed? So like I said, this picture is not new. It's not, we've always had a few dominant currencies. but the literature was very focused on these symmetric frameworks. I think there are two reasons why that happened. One was the fact that there was not much granular data. And so somebody would look at a picture like this and say, yeah, sure, lots of firms claim to be exporting and invoicing in dollars, but effectively the dollar price moves in such a way that it would be like they were pricing in their own currency. So they're quoting the price in dollars, but whatever, prices are actually truly sticky in their own Mexican pesos, and they mentioned also. So that kind of granular data was missing. Then there was this very early study done by Swedish economists using Swedish data in 1973, I believe this was, and that said that, well, if you look at, he did a survey of firms and said that, well, 60% of the firms he surveyed said they were exporting the Swedish krona. So that then became the so-called Grassmann law, which is that though it was only 60%, but still it was okay, you were exporting your own currency. So I think what's changed over the last decade is, in addition to just, having better measurement of the broad facts about what people price in, you also got a lot more data at the very granular level of what the contracts look like, what was the price, how much of price stickiness there was, what was the quantity response, and so on. So I think that has spurred a whole shift into taking this whole idea of dominant currencies and therefore the asymmetries in the international system very seriously. In the talk today, I will be focusing on the global trade aspect of the dominant currencies. There's the international finance aspect to it, which I've done some work on, and others have done work to, but I'm going to focus on this because this has been, in some sense, a central part of the whole discussion. So if you've taken an undergrad class in international economics, you would have been taught the Mundell-Fleming model. So that's the core of the work on this. Okay, so just to give you a quick overview of the first paradigm, the first generation paradigm, which indeed is Mundell, kind of Mundell, Fleming, Friedman, the Dornbusch 1976 paper. All of them came out of basically extending the closed economy models to the open economy. So when you were writing, when you're writing sticky price models, the motivation for that is, why are prices sticky? The prices are sticky because your wage contracts are sticky, so your costs are sticky in wages. So if you're setting your price as a constant markup over your your margin costs, and your wages are sticky, then your prices are sticky in your own currency, right? That would be the argument for why you would be pricing your prices are sticky in your own currency. So now when you're in the closed economy setup, and there's no such question of which currency else. I mean, there's, for the typical country, there's one currency, that's the currency of the country, and that's the price at which you set all the contracts within the borders of the country. Now, when you come to the international context, the question is, okay, now we're getting to 180 currencies. What currencies should we be assuming the prices are sticky in? So the first generation models were the assumption, they just extended the kind of the assumption outward and said, well, yes, your prices are sticky because of sticky wages. So when you export outside, you set prices prices are sticky in your international currency. So what does that mean? So let's take an example of trade between Japan and Mexico. And you have, if you look at exports from Japan to Mexico, for instance, the argument would be that Japanese exports to Mexico are priced in Japanese yen and sticky in Japanese yen. And similarly, the exports from Mexico to Japan are sticky in Mexican pesos, right? So then what happens in the world where the Mexican peso depreciates relative to the Japanese yen? That would increase the price of all imports coming from Japan into Mexico relative to the price of Mexican goods, because the Mexican goods are priced in pesos, and the Japanese goods are priced in yen. So when the peso depreciates, loses value relative to the yen, that's going to cause those goods, Japanese goods, to become more expensive in Mexican markets. And so So that would shift demand away from Japanese goods. You would get a decrease in imports. And on the flip side, because Mexico's exports to Japan are assumed to be priced in pesos, the prices in yen in Japan go down, relatively speaking, and that leads to an increase in exports from Mexico. So this is the classic argument behind, why we have trade wars, behind why there is this push for, countries are very worried when another country's currency depreciates relative to theirs. This is, this is exactly what it is, that you gain market share both at home and in international markets when you have a weaker currency as opposed to when you have a stronger currency. And so this is, even now, for instance, the US administration, and under the previous administration, pushed for, the condition that if you are determined as somebody who is manipulating your currency unfairly and keeping it too weak, then we should be able to apply countervailing duties to kind of offset that. So that's the world, that has been the classic model of how we think about this. It's what we teach our undergraduates in class. Then there's a second generation paradigm that came about, which came from evidence that looked at estimates of pass-through of exchange rates into prices. Now you have defined what the price is, but there were prices of goods at the dock, right? So some people looked at those prices for the US, looked at for a bunch of other countries, and run those pass-through regressions. And though, there's a classic paper on this by Goldberg and Netter, that basically showed that there was a wide range of pass-through estimates, but they're some sort of an abstract or number that stuck in everybody's head was this 50% number, that there was pass-through was 50%, like as if it was common 50% for everybody. But there was a lot of heterogeneity in the data. So that made people then question the first generation paradigm, because the idea was, well, if it is indeed the case that prices are entirely sticky in your own currency, then the pass-through would be 100%. And instead, the data, it seems to be 50%. So the second generation paradigm said, well, actually, when Mexico and Japan trade with each other, prices at which Japan sells to Mexico are actually sticky in Mexican pesos. So that's local currency pricing. While on the other hand, when Mexico sells to Japan, its prices are sticky in Japanese yen, and therefore, again, local currency pricing. So if you make that assumption, then that completely gets rid of any kind of expenditure switching. What does that mean? Which means that if, for instance, the Mexican peso depreciates relative to, or loses value relative to the Japanese yen, then it has no effect on its demand for Japanese goods. Why? Because the prices at which they buy from Japan are sticky in pesos, so it doesn't affect the price at which they face, relative price they face, has no effect. Similarly, when for the Japanese perspective, their imports into Mexico has no effect on the Japanese price at which they're buying, because it's sticky for that period of time, so there's no effect. So there's literally none of this import, contraction, export, expansion for Mexico that comes from the standard Mandel-Fleming framework. And those are the references there on the paper on this thing. So the dominant currency paradigm, so that was PCP, which is producer currency pricing, and then LCP, which is local currency pricing, and then DCP, which is, I guess, dominant currency pricing. So DCP basically says, well, the fact is that these two paradigms don't pass the smell test, at least in terms of the data, right? It's not that when you look at trade data between Japan and Mexico, almost everything they sell and buy from each other is priced in dollars, right? So if you just look at whatever data is available, it's priced in dollars. It's not priced in the yen, it's not priced in pesos, but it's priced in dollars. Right? What happens if that is not just that's priced in dollars, but it is actually sticky in those dollars, then it has real implications which differ from what the predictions would be of the first and the second generation. The first is you have, in this case, when you have so suppose Mexico is, again, buying goods from Japan, all the prices are set in dollars. And suppose that the Mexican peso depreciates uniformly relative to all of its trading partners, including the US, so including the dollar, right? So it's depreciates relative to the dollar. Since Japanese goods coming into Mexico are priced in sticky in dollars, that's going to make Japanese goods more expensive in Mexico's markets. That's going to reduce the demand for imports from Japan. On the other hand, when it's exporting, if you look at its exports, the price at which it sells to Japan are sticky in dollars. The Japanese yen relative to the dollar has not moved because I've assumed that the peso has depreciated equivalently relative to all currencies. So the yen-dollar exchange rate hasn't moved. So the effective price at which Japan is buying hasn't changed. So there's no change in the export. So now you get all the action for a country, when a country's currency depreciates, working mainly through imports, and you don't get the export boom that's typically associated with the Mandel-Fleming paradigm. The second thing is that it's been in an analysis of what's the effect of exchange rates on a country's inflation or on its trade. The standard is to use a trade-weighted exchange rate. Right? That will be completely consistent with Mandel-Fleming, because what matters is the bilateral exchange rates of you with your trading partners. And so if you do a lot of trading if Mexico does a lot of trading with Japan, what matters is its exchange rate with respect to the Japanese yen. But on the other hand, if the world is one where everybody is trading with each other in terms of, say, in dollar terms, then the relevant exchange rate for Mexico is not even to explain its trade with Japan, is not the peso yen exchange rate, but it's the peso dollar exchange rate. And so this shifts, saying the way, like when you run those regressions, the relevant right-hand side variable is not the trade weighted exchange rate, but the invoice currency weighted exchange rate, right? So an example of would be that if, for instance, the Mexican peso and the Japanese, suppose you have a shock that causes the Mexican peso and the Japanese yen to depreciate relative to the dollar and by equivalent amounts, so that the peso yen exchange rate hasn't moved. Under Mandel-Fleming, again, partial equilibrium here, under Mandel-Fleming, you would say that there would be no effect on the trade between Mexico and Japan, because the bilateral exchange rate hasn't moved. But according to the dominant currency pricing paradigm, it would say that trade between Japan and Mexico would decline because both of them now have lost value relative to the dollar, and both of them sell to each other in dollar terms, and that price is sticky, right? And so you would have a prediction would be that a stronger dollar, uniformly stronger dollar relative to all other currencies, would lead to a decline in the rest of the world trade. Trade outside, their trade that they have with the US. It would be across the rest of the world, trade would decline when there's a much stronger dollar. So this is a different prediction than some of the financial channels through which a stronger dollar can create problems. This is coming entirely through the trade channel. And this has very clear also policy implications. For example, what would have been what's the effect of a tariff? So for instance, when the US imposed tariffs recently on China, a couple of years ago, under the previous administration, when they put tariffs in China, the question was, what would happen? Would you see the price at which China sells to the US in dollar terms adjust by enough to offset that tariff, so that effectively the US buyer doesn't really face a higher price? Because at the same time, what happens is that the US dollar appreciates, right? So when you have these kind of a tariff, the dollar also appreciates. And so the question is, would the Chinese exporter, if they were setting prices in Chinese yuan, then the dollar appreciated by just about the same amount as the 10% tariff on average tariff that was put, if that was a complete offset, then for the buyer in the US, that would have had no find the dollar prices which they bought from China wouldn't have changed despite this adjustment or tariff adjustment, because the appreciation completely offsets the tariff. But on the other hand, if the world is one of DCP, where the price at which China sells to the US is sticky in dollars ex ante, then the appreciation of the currency does nothing to that price, and the US buyer faces the entire hit in terms of the tariff. And what we saw was indeed the case that import prices coming from China, dollar prices at the dock barely changed, and therefore the price at which most of the tariff incidents fell on the US buyer. And I have some references here for some of the papers in this literature, but there's a whole lot more. And like I said, we're working on a handbook chapter that will go into all of this in much greater detail. Okay, so that was a very quick overview. I'm going to go into this, give you some more of a flavor of this, but I hope we'll have a bigger discussion and a Q&A. I will show you some evidence and then following implications of dominant currency paradigm. Then I will go into what that means when you live in an asymmetric world in terms of shock transmission. I will briefly talk about what implications are for optimum monetary and exchange rate policy, and then end with an area of work that a lot has been done, but I would say relatively speaking is still in early days, which is recognizing that obviously it's not random that firms decide which currency to price in. There's endogenous currency choice, and how do we just end up in this global equilibrium where everybody agrees that the dollar is in which you trade. And of course, there's complementarities between that and the dollar's role in finance and so on. Okay, so here is a table with the facts. This is a little more granular, not regional breakdown relative to the first graph I showed you. Again, remember, I'm focusing exclusively on global trade. This is a very Keynesian, section, which is it's basically looking at pricing in different currencies in international trade. What this slide tells you is if you look at the US, close to 96% of its exports are invoiced in dollars. If you look at the euro area, it's 77.6% is invoiced in euros. So that might look like pretty Mundell-Fleming. But basically, that 77.6% of price of invoicing in euros is basically intra-euro area trade. So it's like saying that when you have trade within the US, it's priced in dollars. Not so surprising. Again, a currency union, trade within the euro area is mostly priced in euros. But if you exclude the US and the euro area, and you look at trade with third countries, you can see that the US dollar has a much bigger role to play. It's 55% of its trade so 50% of Japanese exports is invoiced in dollars. And remember, Japan is a reserve currency. It's one of the 6 reserve currencies of the world. So it's, despite that, it does 50% of its exports are invoiced in dollars. And also, this is not just a commodity story. This is not a story just about the fact that oil is priced in dollars and commodities, some metals are priced in dollars. No, this is not the case. You can take that out and you can look at the non-commodities in the world, and they are heavily priced in dollars. And if you look at emerging markets, this is even more strongly the case, especially in Asia and Latin America, where they're almost exclusively dollars. North Africa, again, closer to the euro area, history of the French franc that been used there, that you have the euro playing more of a role, has 35% in terms of North Africa exports. But again, the dollar is, we would describe the dollar as the global dominant currency and the euro as a regional dominant currency. Now, again, that doesn't tell me, like I said at the beginning, which is, an important point, was that doesn't tell me anything about whether the prices are actually sticky in these so-called currencies that we are seeing on this table, right? So that's a question. That could be that I'm just quoting my prices are actually sticky in my own currency, but every time I put it in a contract, I write down a dollar price, and so it's just that's what it is. So I think that's where a lot of the data work has happened. Kind of do simple tests of what that implies. So here's just a very, very simple representation of how you would test the stickiness. So let's look at the case, look at a period of time that, let's suppose it within a 12-month period when prices are sticky, and there's granular data for which you can actually show months of price stickiness. So prices are indeed, so suppose the prices are just completely sticky in the currency in which you invoiced it in. So that's what this delta PIJ says, the percentage change in prices. I'm looking at goods going from country I to country J, expressed in country J's currency. So what this tells you is that if the invoicing currency is currency I, so again, if I take my Japan, Mexico example, I'm looking at prices in pesos, J as Mexico, of goods coming from Japan, I. It says that if the exports are coming from Japan, that's country I, and if it is indeed sticky in Japanese yen, then whenever the Japanese yen depreciates by, say, 10%, that's going to cause the peso prices to go up by 10% for goods coming into Mexico from Japan. And that's the only exchange rate that matters. So any other exchange rate I put in there is irrelevant. It's the bilateral exchange rate, which should get a loading of 1. If, on the other hand, the prices are set in Mexican pesos, then again, it doesn't matter. Any exchange rate movement between the yen and the peso or any other currency is not going to have an effect on that price. It's just sticky in that currency, so the pass-through is going to be 0. Loading of 0 on both those exchange rates. And then the last one is the case where you are invoicing it in what they call a vehicle currency, which in this case is the dollar. So it's neither the yen nor the peso, but a vehicle currency. So that's the dollar here. Then the only exchange rate that really matters for the prices in pesos is the dollar exchange rate, right? The vehicle currency exchange rate. So that should have loading of 1. So that's one testable implication. So again, a question, of course, is the exchange rate is not an exogenous variable, it is an endogenous variable. But that is not relevant here because in the case where prices are completely sticky, it doesn't matter whether the exchange rate moving around is for exogenous or endogenous reasons. The exchange rate always moves around for some reason. So in that sense, it doesn't matter. So that's not an issue at all. It does become an issue when you're looking at quantity movements because that's where you have the problem. It also does become an issue when you look at different periods of time because then prices are no longer sticky. They're going to be adjusting, and so you're going to have to be careful about it. There's a lot of work on that front. So what do we see? So this was my paper from 2010 that I did with Oleg Itsoki and Roberta Ringaborn, and this was the first paper that actually looked at. It tested this assumption, this thing over here, but it was done for the US. So in that sense, there was no vehicle currency piece, but the point was that we looked at imports coming into the US and overwhelmingly, like 93% are invoiced in dollars, and the remaining 7% or so are invoiced in a foreign currency. Now there's variation across countries. So when you look at trade with Germany, there's a lot more in euros than the 7% number, but that's where the variation comes from. So the typical pass-through regression you would run is the one you see, which gives you the aggregate pass-through coming into the US. That's the black line. The black line tells you that if I look at aggregate pass-through coming into the US, it's about 30%, 24 months out. So if the dollar depreciates, this is done at the bilateral level. So basically think of it as if the dollar depreciates relative to all of its trading partners by 10%, then prices at the dock in dollar terms go up by 3% for 24 months out. And it's about 20%, pretty much immediately. So it goes from 20% to 30%, right? Now, what we did was that we broke this data up into basic goods coming into the US that are priced in dollars versus goods coming into the US that are priced in a foreign currency. And what you see here is that you see the stickiness part, which is the fact that everything that's coming into dollars has a pass-through of 0 initially, which is what you would expect. And everything that's priced in the foreign currency has a pass-through of 100%, as you would expect. So that part is exactly in line with what you would think of sticky prices. By the way, this data also had very granular evidence of stickiness, so this was not surprising, but this is exactly the picture you would expect, which is that in the short run, the goods that are priced in dollars have pass-through of 0, the goods that are priced in the foreign currency have a price of 100%. What is more surprising is that as you stretch this out to 24 months, when you feel like you've gone past periods of pure price stickiness, those two lines don't converge, right? So now this obviously, there's a lot of mixing up. There's still goods there with sticky prices, and that can create a problem. But this is something that we did this for the US. Since this paper came out, there's been many other studies that did this for other countries that showed that this pattern was there even, for pretty much every single country that people have studied. And countries where it's not the US on the one side, so you actually have vehicle currency used. So many countries, many recent studies confirm these patterns of pass-through by currency of invoicing. So what this told you, when it gives you, is that when people claim to be pricing in a particular currency, it is indeed the case that prices are sticky in that currency. So it's not as if, that they might be having, that there's some disconnect between the price that they say they're pricing in and the actual price in which their contracts are sticky in, or so on. It's not the case, right? So that was the first piece, was to say that it is the case that you have price stickiness in the invoicing currency in which you are priced in. And these are regressions that are run by, this is doing this for a large sample of countries put together. But so if you look at what this basically does is projects the percentage change in prices of goods. Again, let me take my Japan, Mexico example. It projects the prices of goods, percentage change in the prices of goods coming from Japan into Mexico, and regresses that on the peso-yen exchange rate. That's the first column. That's the standard regression that always gets run. And you get a pass-through of 0.8, close to 0.8. That seems very much like producer currency pricing, Mandel-Fleming. But on the other hand, if you then, what the second column does is just include the exchange rate of the Mexican peso relative to the dollar as another control in the regression. And when you put that in there, you see that it completely knocks out the bilateral coefficient. And what's determining the price movements are not the bilateral exchange rate, but the dollar exchange rate of the Mexican peso relative to the dollar. The right graph then, it runs it. SJ is a share of a country's currency that's invoiced in dollars. So it's basically, saying that this is not just a dollar phenomenon, but it is very close to twice how much of a country's trade is invoiced in dollars as opposed to euros. So you see exactly the same thing, which is that including the dollar in these regressions reduces the relevance of the bilateral exchange rate. And there was also a nice paper that was done on the UK, which says that it's then easier to understand why some episodes led of the pound weakening led to high pass-through into inflation as opposed to other episodes. And basic argument was that in both those cases, you needed to figure out what was happening to the pound relative to the dollar, as opposed to the trade-weighted exchange rate for the UK. So that was a driving factor. So this is kind of a shift of how you have to do things when you think of the dominant currency paradigm. Okay, now when it comes to pricing in international trade, there's always this question of, again, sure, you've shown me that prices are actually sticky in the currency of invoicing, but these are contracts, these are business-to-business contracts. These prices may not be allocated. A lot of these prices are also within, they are intra-firm trade. So that in that sense, they're not allocative. They may not be allocative. But even if it is not intra-firm trade and it's arm's length trade, but again, these are contracts and the price may not be allocated. This is kind of the standard battle critique of wage stickiness, which is that, wages are sticky, but who cares? They're not allocated. Again, a lot of recent work has been done that shows you that when you look at quantity movements, so, actual quantity adjustments, then in that case, you do find things work as you would expect. So they face a downward sloping demand curve. When the prices at which you buy goods go up, you buy less of it. And again, what explains these elasticities and how much quantities respond is again the dollar exchange rate and not the bilateral exchange rate for countries. Again, that reduces the relevance. I should mention here that the endogeneity issues of exchange rate are more problematic in this situation because the shock obviously driving it has an implication for overall level of demand in countries. There's a lot of work that's been done, including using U.S. monetary policy shocks in the U.S. to tease out to instrument for exchange rate movements, and then look at trade across third countries. So that you think that there would be less of this endogeneity effect, and all of them continue to confirm this basic fact. And what matters for trade across countries, even if the U.S. is not on either side of the trade transaction, is if you are a heavy dollar user, then it is your exchange rate relative to the dollar that's bilateral exchange rate. And then this is another paper that I put out with my co-authors at the IMF that looked at tested the phenomenon where when your currency depreciates in the short term, which is over about a 1 to 2 year horizon actually, most of the adjustment comes through reduction in imports and not through an expansion in exports. And indeed that is the case. You do see you do see this as a short-term graph. You do see that initially it's all adjustment through declines in imports, barely anything on exports. And then over time, you start getting more of when we get kind of out there to 3 years, you start getting an export response, but it's not during the period of price stickiness. So all of these facts line up well. So again, summary of evidence of the allocative effect, which is firstly, you do have a strong response of import prices to the dollar versus the bilateral, as opposed to the bilateral exchange rate. And with the differential effect that's increasing in the US dollars invoicing share, differential consumer price responses and also there's now very granular data at the consumer level, which looks at the consumer response. So all of this has been at the docks, but you might ask, well, does all of this translate then into the final consumer who's buying these goods? And you actually do see it, because there's a very nice paper by Alberstein and Line which look at the transmission from the dock to the consumer. It shows you that indeed the currency of invoicing plays a very important role even at the consumer. It's definitely muted because obviously you have non-traded aspects like transportation and so on that feed into the price, so that's going to mute the effect, but you still see an important difference depending upon the currency in which you're pricing. I make one more point, which is that since I seem to be completely running out of time in 2-3 minutes, let me just continue. But there's a very nice paper by Barbero, who's which looked at it, basically said, well, suppose I am indeed a Mexican exporter selling to Japan in terms of dollars. Okay, maybe Japan doesn't buy immediately more quantities of my good because the dollar prices has stayed the same. But as an exporting firm in Mexico, I've suddenly got this big gain in terms of cash flow gain, because everything I sell to Mexico now, to Japan now, I get more Mexican pesos for it, and that should have an implication. So this is also something that this paper explores and finds that indeed it is the case that you have this cash flow sensitivity. Okay, so what does this mean? I want to stop in the next 2 minutes, but I'm going to give a very quick flavor of what that implies. So when you live in this asymmetric world, firstly, it implies, without going into the details of this picture, it implies that when you have a shock that originates in the US, say suppose you have a monetary policy tightening in the US, which again is something that everybody is now, thinking about, in response to say high inflation, you have a monetary policy tightening in the US that causes the US dollar to appreciate relative to other currencies. That appreciation passes through into other countries because everything is priced in dollar terms, at least at the dock. And so you have the depreciation of your other currencies that causes inflation to go up there, and then triggers them to start raising their interest rates to control inflation. And the bottom two graphs show you that you have a negative effect on world trade. On the other hand, if you have a monetary policy tightening emerging out of, say, Japan, it has almost no effect on rest of the world trade, which is what the graph here shows you. The graph C shows you, and in fact has a slight positive effect on world trade, and has none of the spillovers that causes other countries to need to tighten at the same time that the Japanese central bank is tightening. So again, you get these asymmetries. What do we know about optimal monetary and exchange rate policy under the dominant currency paradigm? This is relatively new literature, so I will, we're still figuring this out. But if you take a very kind of set of assumptions, which are very standard in the literature, and the only thing you have is pricing under dominant currency paradigm, you could ask, well, does that then overturn the Friedman rule of flexible exchange rates? The answer is no, it doesn't. If the only thing you have is price stickiness is a problem, you still get flexible exchange rates as the best thing to have. But that said, you cannot close the output gap because you only get the benefit of exchange rates working through the import channel, not through the export channel. And so you get partial adjustments, and so you cannot close the output gap. So now when you combine that with any of the financial risks that go around with exchange rate fluctuations, then that's when you start getting a stronger case for some amount of moderation of the exchange rate. Lastly, let me just conclude on endogenous currency choice. There's a lot of work being done on this. I'm going to skip these slides and leave with one table here, which is basically, why do you end up at an equilibrium where everybody's pricing in dollars? There's one channel is that if I'm an exporter, most exporters, large exporters especially, tend to be importers too. So if everything that I import is priced in dollars, then by pricing my exports in dollars too, I'm kind of hedging the cost movement. And so that would be the optimal pricing strategy for me. Secondly, if I'm selling to markets, like say, if I'm Japan and selling to Mexico, and everybody else selling to Mexico is pricing in dollars too, and there's some strategic complementarities in pricing, then at least for certain sets of goods, that would give you another argument for why you would want to price in dollars. And the evidence is indeed consistent with that. So let me just conclude with this last slide on future work of, there's more work to be done on trying to understand transmission from border prices to producer cost, consumer prices, and quantities. Further empirical work linking the dollar's dominance in trade and the dollar's dominance in finance. I've done some theoretical work on that, but there's a lot of work that can be done. Also getting into the welfare effects of dominant currencies and so on. But let me just stop here since I have gone, about 45 minutes or so. Yeah, thank you. Now we'll stop sharing. Okay.
Hi, this is David Zilberman, professor from Berkeley. This was really an enlightening lecture, especially because a lot of agricultural commodities are priced in dollars, and I think we really got some sort of better understanding what happened when you have, for example, a trade war between the U.S. and China. How all this changes when we have all this soybean boycott of China and the US? How did it affect things beyond the direct fiscal effect? What was the international trade effect? I'd like to ask you another question that is totally unrelated. A lot of people think that it may be a better idea in the long run to have some sort of basket of currencies that will be used for international trade. How will it affect this type of outcome? Did anyone I'm sure you can develop a model, but did anyone start to think about the implications, the welfare effect, etc.?
Thank you. Do you want me to wait for all the questions, or should I just respond?
You could go ahead and respond.
Okay. So thank you for your questions. When it comes to agricultural commodities, of course, those are what I would describe as flexible price goods. So goods where a lot of them get traded on an exchange, or otherwise the prices are just moving all the time in response to supply shocks or demand shocks. So those are not. Certainly, there's the other aspect. There's still an aspect of the dollar being associated with it. So for specifically for agricultural exports for the U.S., what you saw after the trade, the trade tariffs that came about between the U.S. and China, is you saw the kind of the wedge as you would expect to see it, which is there was a world price at which you could of agricultural goods, and maybe soybean too, and the U.S. exporter was basically making a lower amount than that world price by the amount of the tariff. So, it's exactly like a flexible price situation. So, it's not the sticky price kind of story. So yeah, so there were, as we know, that there were hits to U.S. exports in terms of agricultural products, and you could see that there was an absolute trade diversion of buying from, I believe it was Brazil that received the benefit of some of that boycott. One of the countries that received the benefit. In terms of a basket of currencies being used for trade, so I think here is where the interconnectedness and the dollar's role in multiple dimensions that has an important aspect, which is the dollar's dominance in international finance is also very central to it being used in international trade. And so when you start thinking of a basket of currencies for trade, you're going to have to start thinking of creating, of assets that also are tied closely to this basket of currencies that then reinforce the trade and finance role. So right now you have very deep markets for the dollar, very liquid markets for the dollars. That strong network is it's these strong network effects that make it very difficult to kind of break this equilibrium and go to another one where another currency becomes dominant or a combination of currencies become dominant. So it's not something that happens very easily. Again, you want a currency that is very deep institutional backing, very deep markets. And now we are in equilibrium where many countries in the world care a lot about the movement of their currencies relative to the dollar. So kind of to shift that equilibrium, this is a multiple equilibrium problem. So shift that equilibrium is far from trivial.
And we have a question online. This is from Patrick. Is there any reason to expect patterns of exchange rate responses to be different for agricultural trade relative to trade in other products?
So let me just understand the question. Is the question is that if suppose you had a shock in agriculture, the effect on exchange rates versus shock in other sectors, or was it the other way around? I couldn't tell the.
I could read it again. Is there any reason to expect patterns of exchange rate responses to be different for agricultural trade relative to the trade in other products?
So yeah, so when you think of trade in agricultural products, especially if we are talking about, if you're talking about goods that are basically, you're talking about flexible prices, then again, a nominal exchange rate itself is irrelevant, as we when you're in a world where prices are fully flexible, nominal exchange rate really doesn't have a role. What matters is the real exchange rate, and then and so to figure out what the effect is of nominal exchange rate movement on agricultural demand for agricultural goods and so on, you kind of want to look at what's happening to other components of prices and so on. So it's the real exchange rate that really matters. When we look at but on the other hand, when you look at other goods where the prices are indeed sticky, that's where you really can test that's where the classic currency wars arguments come from, which is that I have a price that's sticky in a particular currency. When the nominal exchange rate moves around, it causes relative prices of that good in different markets to move around, and therefore that changes the demand for it. So when I think of agricultural goods, I think I would be stepping back to think of has there been a supply shock in agricultural or overall demand shock in that that is along at the same time that the exchange rate is moving around. So it's not a very it's again that we're getting now into the flexible price world where all of this matters.
We have another question online from Ian. He said, you mentioned the issue of China strategically allowing its currency to depreciate. What does DCP mean for evaluating whether China is explicitly undervaluing the RMB?
Now, when you get to questions of undervaluation, so this is again what DCP tells you is that it doesn't change the basic point that a weaker currency helps you. The only thing it does is it tells you that it helps you less than if you were in a world without dominant currency. So if you were pricing entirely in your own currency, then in that case you would get a bigger bang from a weaker currency, and you would get both an increase in decline in your imports and increase in your exports every time your currency depreciates. Under DCP, you get a decline in your imports, but it's not a big expansion in your exports. And so one of the arguments that countries make is that when you're in a DCP world, it's not as if because I'm weakening, because my currency has depreciated, I'm getting this big bang increase in exports, which comes from the original Mandela paradigm. And so therefore, it's not as if I'm manipulating my currency to get these big exports, right? So that's one sense in which a weaker currency doesn't automatically lead to a big increase in export. Now, of course, you could have the other case where a weaker currency doesn't lead to a big bang in exports immediately, but because you get these big profits that come from dollar prices that haven't changed and a weaker currency, and you get this cash flow that eventually over time you're building up more in terms of your exports. So it doesn't happen immediately, but it happens over time. Now, the question of figuring out whether a country has exchange rate is overvalued or undervalued is $1 million question, and something that is in fact core to the mandate of the fund. Is one of the things that we are required to do is we come out with the external sector report, which exactly does this, which is trying to figure out the status of currencies. The approach we take is to focus on current accounts and to see whether is your current account imbalance too big, or do you have too big a trade surplus, or does it look about right? And when you do that kind of analysis by construction, because it depends not just on what you do, but at what the rest of the world is doing, many factors come into play. So it's far from a trivial exercise to figure out what whether a currency is overvalued or undervalued.
So actually that question was from Ian Sheldon at The Ohio State University, and in a somewhat related follow-up, what does DCP mean to models where you get quality upgrading with a currency depreciation? And he mentions Verhoeven's 2008 QJE piece on Mexican exports after that peso crisis in the mid-1990s. And this is going to be your last question, so feel free to wrap up and make any other closing comments you might like.
Yeah, I feel faintly like I read that paper by Verhoeven, but now I just don't remember what the findings were in that paper. But just more generally to the question of weaker currencies, since again, the way I would, again, I don't know what this particular paper, but the channels I would think of is that if I'm, since most exporters also are importers and they use imported inputs to sell produced goods, they export, and if they're especially the higher the quality of the good, often they use lots of imported inputs. And so if your currency depreciates and you're buying all the stuff is in dollar terms, then that makes these inputs very expensive. And again, now, of course, you're exporting in dollar terms too, so you get a bit of a natural hedge. But if you're not fully exporting and you're also selling locally, then you might shift through the quality ladder and you might go towards less high quality goods. So that would affect the kinds of goods that you end up producing. I had a paper on Argentina which looked at what happened to imported input use during the 2001 devaluation, and indeed we saw a big switch away from imported goods towards domestic goods, but that shrunk the range of goods that they could actually produce because some of the imported inputs did not have a domestic substitute. So those are the kinds of channels that could come into play.
Well, thank you so very much. Why don't we both here in Austin and virtually give our appreciation to Gita for her remarks this evening. I think we all will think a little bit harder next time we hear about some of the trade news that comes out of our administration. And so thank you very much for your comments. And with that, we will wrap up this year's 2021 AEA meetings in Austin. Thank you for coming. For all of you virtually at home that joined that way this year, thank you for being patient with us with the program as it came together. This was a great way to end a program with such a thoughtful discussion, but we hope to see everyone next year in Anaheim, if not sooner, and have a good evening. Thanks all.